Alrighty then. It's Thursday. It's 4 p.m.-ish. We're live. There's not a ton going on today, but what is happening is pretty interesting and it's pretty good. And so I wanted to discuss that. I want to take a look just at what has been going on in the marketplace. I've seen several things that are super interesting. Number one, I've seen some homes selling for way less than they originally listed for. Not really comp bombs, but getting close to that. But also still seeing frenzies at some of the lower price points where, you know, there's still lots of offers and people are just kind of getting the immediate, you know, we can't take any more offers kind of thing. So seeing the gamut still right now. And I think it's going to be a micro market kind of situation that we're in. So let's take a look at this first. The Fed testified yesterday before Congress about inflation. So we're going to take a quick look at that. And why did mortgage rates drop yesterday nicely? And then again today on the heels of that. And should we consider or should we expect more of that? That's what we're going to discuss today. I'll also give you a sneak peek at my television segment from yesterday and what we kind of discussed in case you missed that. I'll have that link as well. All right, Derrick Evans here, VA Home Loan Specialist, NMLS 155010. Give me a call, shoot me a text, or an email if you want to buy or pull the trigger on a refi. Rates getting a little better, helping refis make a little more sense right here. Let's get myself out the way. So Powell tells Congress the Fed is strongly committed on inflation, notes recession is a possibility. We will be in a recession. I'll just tell you right now, as of next Friday, so a week from tomorrow, they'll probably delay the release of the numbers as long as they can. I don't expect it to be a big negative number. Remember, recessions are not created equally. Some of them are smaller. You know what? Let's actually pull up this chart. Some of them are smaller. Some of them are longer and deeper. And if you look on any of these Fed charts, one of the things they do is they gray out. So the gray vertical lines there are the recession areas. You can see the one for COVID here was the smallest one that I've seen on here. Most of them are either this length, which is about a year and a half, or this length, which is like 6 to 8 months. See, there's another 6 to 8 months. Here's a year and a half. Here's a 6 to 8 months. Here's a year and a half. And so I kind of expect us to either be probably in a 6 to 8 month recession, most likely. I think it'll probably turn it around pretty quick. There are actually a lot of positive things taking place. And so I want to stay focused and pragmatic on this. Don't let your political, leanings or anything like that fray you from the truth here. Let's keep an eye on the truth. What does it look like? What's really going on and what's likely to happen? So if we look at what Powell said, he said they're strongly committed. They're so strongly committed that they told us that the inflation, which was rampant and horrific last year, was transitory. Dummies. But now they're committed. Now we're committed. And this means higher interest rates until, quote, compelling evidence emerges that inflation is coming down. Remember when I was telling you what we should expect to happen here is as soon as the numbers as soon as we get over the hill, in other words, we see the numbers stop increasing, the inflation numbers, they stop increasing and then they start decreasing. And when that happens, oh man, they're going to be licking their chops, ready to start firing stimulus bullets in every direction. Oops, wrong one. I'm telling you. And that's when rates are going to dip significantly and it's going to be game on again. The bubble and the crash that everyone is expecting this time around isn't going to happen. It's going to happen the next time. Too many people are expecting it this time. It can't happen this time. It's going to happen next time. After the next run-up will be the bubble. We haven't seen anything yet. That's my prediction. I want to get into more of that in the coming days and weeks, but there's no crash coming this time. A lot of people say, oh, it's going to be so bad, the underlying this and that. No, probably not. But it could. And so we have to keep an open mind. Here's what he said. At the Fed, we understand the hardship high inflation is causing. We're strongly committed to bringing inflation back down, and we are moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. they have the tools. I don't know about the resolve. If you look at it, they've only increased rates 1.5% in the last year and a half. And, they've increased it each time, 25 basis points, 50 basis points, and 75 basis points. So it's, it looks like they're just sort of trying to catch up. You know what's worse than high inflation and low unemployment? Let's hear here at Warren Powell that tipped this economy into recession. So they're talking about recession. A recession is basically designated by a recessing economy, meaning that it's no longer growing, it's retracting. You call it a retraction. We just call it a recession. It's recessing. It's coming backwards. Negative 1.5% in the first quarter. We're going to have a small negative number, I think, for the second quarter. And so we'll technically be in a recession. But it may not be a bad one. I think it's going to be one of the shorter ones. And most likely, the worst is probably behind us. So here's what Powell said about recession. It's certainly a possibility. It's not our intended outcome at all, but it's certainly a possibility. And frankly, the events the last few months around the world have made it more difficult for us to achieve what we want, which is 2% inflation and a strong labor market. This is one of the things he said that was really interesting. Achieving a soft landing, which policy tightens without severe economic circumstances such as a recession, will be difficult, he added. It is our goal. So a soft landing is our goal. It is going to be very challenging. It has been made significantly more challenging by the events in the last few months, thinking here of the war and commodities prices and further problems with supply chains. The question of whether we're able to accomplish this is going to depend to some extent on factors that we don't control. Okay, there's the cop-out. It's not totally in our hands, which you could say, well, obviously it's not totally in your hands, but you just said, let me go back. I'm going to go back on this. I really want you to see this. You just said that you had the tools and the resolve to fix the problem. And in the same testimony, you said, well, the question of whether we're able to accomplish that is going to depend to some extent on factors we don't control. So let me just remind you what they said earlier. Let's see, it's up here. We have both the tools we need and the resolve to restore price stability. And then later on, we may not. Some of this is out of our control. So can you trust any of this stuff? Listen, you know what I think about these guys. They're boneheads. They're just talking faces. They're academics. They're bow tie guys. They're not boots on the ground. We can't count on them to save us. We just can't. President Biden yesterday, in fact, my segment, so I did a segment yesterday, One American News. I'll leave the link. It's on Rumble. Talking about the economy, talking about, potential downturns, talking about real estate, we actually didn't get to a couple things because I got cut off for this press conference. The president was calling on Congress to suspend the gas tax. And the host was asking me, what do you think? Like, is that going to do anything significant? Like, should we expect that to do anything huge for us? The answer is no, it's not going to do anything huge, but it certainly doesn't hurt. Gas prices obviously have been bad. There's lots of other ways to lower gas prices that would be beneficial, like all the way around. But, this administration doesn't want to do that. So it is what it is. We also did see here, let me see, how's this going to play out? Is that going to work? Home sales posted rare decline for May as mortgage rates rise. So typically April and May are the best months to sell your home, to actually close on the sale of your home, price per square foot wise in San Diego County. And I imagine it's probably the same for a lot of other counties. I thought this one was interesting because Forbes actually noted this, a rare decline for May. A rare decline. And so there's certain things like when we go through change, especially when we're establishing new normals, it gets a little choppy. It's a little rough. It's not super smooth. Right now we're establishing new normals. We're establishing new normals in interest rates. Right? We've been so used to being down here for so long. Look how long we were down below where we are. What does this go back to? 2009? We haven't seen rates where we are today since 2009. We are really sort of shifting the normal here. We also talked about the two things that I'm watching, which is obviously the rise of rates. If rates continue to rise at the clip that they have been so far this year, we'll be at 8% mortgages by the end of the year. And so that would obviously be a huge, huge problem. And then also investors. This was an interesting stat from Redfin. So the way that they are defining an investor for the sake of this graph is, let me read it to you. We define an investor as any institution or business that purchases residential real estate. So not investor like, I buy an investment property, I'm an investor. No, actual institutions or businesses who are buying real estate. And that's a really important distinction, because what you're seeing here is you're seeing a huge spike. Now look at this. Look at this big drop right here, the COVID drop, and then the run up. Let me just tell you, it just reeks of Wall Street. It just reeks of, and the stock market did the same thing. Let's knock everybody out and then take it the direction we want it. So you can see here, we're at almost 20%. This has gone up a little bit since. Let's call it almost basically 20% is a record by quite a bit of investor market share. I've been telling you about this lately, that it's one of the gotchas that I've been trying to track. It's a difficult thing to track, but I'm trying to track this. If we have redemptions, if we see these big institutions that are buying real estate have to exit the market, will they crash the market? Could they crash the market? I don't know. I don't think that they would. I'm not sure if they could, but it's possible. And so this is something I'm watching closer. Actually recording a bunch of segments in studio tomorrow. Going to be chatting with other boots on the ground, some really good agents in the marketplace, get their opinions on some of the stuff. Some people have some really interesting insight to bring to the table, and pretty much everyone agrees on some things and disagrees on other things. So it should be really good conversations. And this is the thing for me, that this is the only thing I can find that might be a gotcha. Hey, if 20% of homes are owned by institutions, and that's a new record, maybe that is a red flag. Maybe it is. I haven't seen any reason to believe so just yet, but maybe it could be. So we're watching this thing here really, really closely. And this is actually a very good read. Redfin posts a lot of good insight. They have a really good news department, stats department, stuff like that. There's a lot of really good information on here. Like this, when you get to this link, you can check out all these things. There's tons of stuff in here. So it's definitely worth taking a look at. Okay, mortgage rates. Let's take a look at what happened here the last couple of days. So we have, this is Monday. So when I did the video Monday, we were like, hey, it's not a terrible candle, not too bad. It looks like we've got, some bullishness left in this potential V-shaped recovery. And we actually have gotten a new trend line here going, which is great. We didn't have a great day today, but we're up 27 basis points. I'll take it. We were up much higher at one point. So we got some rejection off of resistance here, but let's see what happens as this comes to a head. Do we break down from this trend? Do we move higher? It would be nice to move higher, even if we just consolidate up here for a little while, just so we can create a bullish flag. Right now, we just have one bear flag after the other, and it's getting us nowhere. So it would be great if we could consolidate at a little bit higher level here, create more of a bullish flag, and then be excited about that. But yesterday we were up nicely. That's right here. Today we're up 27. That's great. Yesterday was Powell day. Why did rates drop? What is it about what Powell said that made rates drop? Well, remember from the very beginning, we've been talking about how mortgage bonds, worst enemy, and really the enemy of all bonds, is inflation. That is the worst thing, because if you're selling a 4.5% bond to people who are experiencing 8% inflation, you're selling them a negative 3.5% annualized return. No bueno. Nobody's going to want that.
Hated it.
People want to hear that their investment is going to make them money.
All we want to do is pump you up.
That's what they want to hear. No one wants to hear, well, your money's safe here, even though it's technically losing to inflation. So what we want to see is lower inflation. Well, if the Fed is saying we're strongly committed to that and we're going to raise the overnight lending rate to help with that, it's this weird paradox where the Fed says they're raising rates, but mortgage rates are actually dropping. This paradox is important for us professionals, for the professionals who are paying attention here. It's very important for us to explain this to the public, because what they're going to hear is just this. Central bank strongly committed to bring down inflation, monetary tools. That means higher interest rates. That's what they're going to hear. They're going to hear higher interest rates. So that curbs sentiment. It makes people believe that interest rates are just going to keep going up and up and up. And so that's not a great thing right now. We're no longer in the mania phase. When we were in the mania phase, rising rates was a fence sitter thing. It would get people off the fence. Oh, rates are going up. Okay, we better get locked in. Now that rates are already up and they're expected to go higher, it just sort of takes the wind out of the sails of certain buyers. So what they need to actually understand is that that is a very deflationary thing. When the Fed raises rates, that's deflationary. Deflationary things are good for mortgage bonds. So if the Fed continues to do deflationary things, including raising the overnight lending rate, it could be helpful to mortgage rates, for mortgage rates to go lower. And one of the things I said on TV yesterday was, if the Fed really knew what they were doing, they would not have been buying bonds when mortgage rates were at all-time lows. They'd be buying bonds right now and putting a ceiling in on rates to basically say, hey, we're not going to let the 30-year conventional fixed-rate mortgage go above 4.5%. We want that thing to stay right there. So if it gets down to that level, we're going to buy. And we're just going to put a limit buy order in right freaking there, wherever that is. We're just going to put buy order in, just a buy wall in right here, just $1 gazillion worth, and you are not going to get below that level. And they could do that. They have the ability to do that. And once they put that buy wall in, all of a sudden, just the trading and investment sentiment in bonds would totally change. Everyone would be like, well, I'm not going to fight that, so let's buy it. And then you'd see rates go down more naturally. But they don't do that. They're so dumb about the way they do it. If they did that, they would get the benefit of the money that they were spending on purchasing, but they would also get the benefit of the market reacting to their transparency. And they just they're not smart enough to realize that this is the way they should do it for whatever reason. They're very smart people, but they're not smart enough to realize this one simple thing. So it is what it is. That all said, I do expect that rates will go higher between now and the end of the year. So when we get these opportunities to lock, like we've had the last couple of days, should really take advantage of it. Now, the lock and shop stuff we were talking about for a while, pretty much dead in the water. It's gotten to a point where the bank's losing so much money on it that they want to charge an upfront fee for it. That all of a sudden doesn't make sense, especially in my world. You don't want to be attached to any one bank. You want to be free to float about or move about the cabin. And if one bank has a better rate one day, well, let's go with them. Why we want to take a higher rate? Let's not do that. That would be dumb.
No!
Bad timing today.
Yeah!
So we don't want to do that. So lock and shop, not as hot of an item at the moment. Banks really got brutalized by it, and I thought they would. I was really surprised that they were willing to do that, given the current macro environment for bonds. But essentially, here's what's going on with this. So we have just wanted to kind of redraw this. So we have this trend line in place. That's helpful. Here's what is in the process right now of breaking down. That was the old downtrend, and it looks like we've gotten out of it. So there's a micro downtrend that we may have escaped. Let's see what happens. If we get a big red candle tomorrow and it could take us right back into this. But if we bounce, then that would look really good. That would put us in a really good position, because part of the reason, am I in the way? I'm not in the way. I shouldn't be on here. Part of the reason that rates are getting better right now, especially in broker space where I operate, is because of the competition between the banks. The banks are fighting for brokers to send them the business. And I love this concept, the way that it works in the broker world. The banks are absolutely tooth and nail fighting for volume right now, and they're doing that by simply lowering their rates. Because what happens when you pull a scenario, here's one I just pulled a little bit ago. It's a $640,000 VA purchase, Condo. And they know that brokers are looking at Loan Sifter, they're looking at rates, And who's at the top? You know, who is number one? That's who gets most of the business. Just like in the old days when you're doing like SEO, the number one result on Google gets the 93% of the clicks, and number 4 gets 0.4%. Like, you want to be number one. So these guys are really fighting right now to be top echelon, the top of the rate sheet, because this is where they know brokers will go. And there's certain situations where CMG is just the best, and this is one of them. And as much as I love 80% of the people at CMG, we try to avoid them if we can. They're great people with just a platform that's a little rough. UWM, on the other hand, is amazing, but you can see here they're getting smoked. They're getting smoked. A good 30 basis points or so. And they've done a lot to improve their rates. So we get this competition amongst the banks on top of good price action in mortgage bonds, and we get lower rates. So while we're sitting here looking at and being told, you know, recession, it's going to be really bad, everything's going to be horrible, you have no idea how much home values are going to drop and how high rates are going to go and all that stuff. Just remember, it's also possible, maybe even more likely, that this is sort of a blip recession. Sort of a blip recession where, yes, certain commodity prices have gone up. Yes, there are certain supply chain issues, but those things kind of already exist. So the question is it going to get worse? Is there going to be more supply chain issues? Is there going to be even higher gas prices? Or do all of those negative things which now exist, do they have a chance to get better? See, they have a chance to get better, right? They could get worse, but is it more likely they'll get better or they'll get worse? Once we identify a problem, typically things should start happening to solve it, right? So things could improve. And now imagine if rates went down 1% and gas went from $5 to $3 or something like that, what would happen? You know, it would just be game on all over again. We would basically just be an absolute rocket ship higher. And so we have to realize that is also a possibility. It's also a possibility. But these things take a lot of time. It takes the general public a lot of time to digest this information, to really know what's going on, and to see what action steps they're going to be taking. I do know right now that the market is getting worse for sellers and it's getting better for buyers. If you want to put it simply, that's the simplest way to put it. It's getting better for buyers. It's getting worse for sellers. So if you're a buyer, you should welcome that. If you're a seller, you might want to get on your horse. You might want to get in action.
Check, please.
Get moving. Get moving. Because as buyers begin to rule the roost, things change a lot. And it's about damn time that buyers have had a chance, had some hand. And they finally got it. So if you are a buyer in this marketplace, get an updated rate quote from your lender. If you're working with me, you've already heard from me. Rates have dropped. Let's get an updated quote. If you're working with someone else, they're not responsive, you think their rates are too high, give me a shout. Shoot me a text, call, email. Let's make sure you're getting a good deal. Send me your loan estimate. I'll tell you if it's legit. If it's a good deal, I'll tell you. I'm not trying to steal business from anybody. I just don't want people to get ripped off. That's all. I see so many people get ripped off, and it's bullshit. So if you are paying attention to this channel, you don't want to get ripped off, or your friend or whatever is doing refi, just say, hey, send your paperwork to this guy. I'll double check it. Make sure it's good. A lot of times what I tell people is, hey, you know what? Your rate's fine here, but they're charging you some BS fees. Why don't you tell them to waive those fees, and then you'll do it. Sorry to all the LOs on the other end of that. So that is where we're at right now. That is what I'm paying attention to. That's what I'm looking at. Check these links in the description below and give me a shout if you want to buy or refi. I'll be here if you need me. Have a great evening, everybody, and I will be back again soon. Take care.